What is dollar cost averaging? Dollar cost averaging, or DCA, also known as continuous dollar plan, is a method of investing wherein the total amount to be invested is divided into periodic purchases of a target asset in order to lessen the impact of fluctuations on the overall purchase. The acquisitions are made at regular intervals and regardless of the asset's price. This method is proven to be very efficient as it eliminates a lot of tedious processes of trying to time the market in order to buy stocks at the optimal price. How does dollar cost averaging work? By purchasing the same little amount of an item on a regular basis, dollar cost averaging strips the emotion out of investing. In other words, when the prices are high, that's when you buy fewer shares. On the other hand, when prices are low, that's when you buy more. Sounds interesting, right? Let's dig into this a little bit more. But before we continue with the rest of this video, please remember to click the subscribe and thumbs up buttons as well as the bell notification icon. This way, you'll be the first to know whenever we release new exciting videos. Also, we'd love to hear from you, so please leave a comment in the comment section below. Make sure you watch the entire video as we will mention a free way for you to win a $20 Amazon gift card. Okay, now let's continue with our video. The idea is actually pretty simple. Let's say you're going to put $1,200 into mutual fund A this year. Ideally, you have two options. It's either you invest all of your money at once at the start or end of the year, or you invest $100 every month. While it may not be obvious that choosing one technique over the other makes much of a difference, spreading out your purchases in $100 monthly increments over the course of a year is actually bound to result in you owning more shares as compared to buying it all at once. Who benefits from dollar cost averaging? Now let's talk about who benefits the most by using this method of investment. Dollar cost averaging is best to consider if it's your first time investing and you only have a little amount of money to invest. This method also works if you're the type of person who's not interested in doing extensive research that goes into market timing, or if you're investing in retirement accounts such as IRA or 401k on a monthly basis. Regular investments through dollar cost averaging give you an assurance that you still invest even when the market is down. Maintaining investments amid market downturns might be scary for some people. In low markets, however, you risk missing out on future growth if you stop investing or withdraw your present investments. According to research done by Charles Schwab, those who stay invested during bad markets have traditionally enjoyed better returns than those who tend to automatically withdraw their money and wait for the market to grow again. What are the pros and cons of using dollar cost averaging as a method to work on your investments? Let's start with the pros. Number 1. Risk reduction. Dollar cost averaging significantly lowers investment risk while preserving capital in case of a market meltdown. It helps in preserving funds, allowing for greater liquidity and flexibility in the management of an investment portfolio. DCA also overcomes the disadvantages of lump sum investing by purchasing an asset while its price is artificially inflated due to market sentiment. Doing so results in the acquisition of a smaller quantity of security than what's required. An investor's portfolio will depreciate when a security's price reaches its intrinsic value as a result of a market correction or when a bubble bursts. Number 2. Costs are lower. Investing in market assets while prices are falling usually offers a bigger return. Using the DCA method potentially assures that you buy more securities than you would if you bought at a high price. Number 3. Ride out market downturns. Using the DCA approach, which involves investing little amounts of money in dropping markets on a regular basis, can help you ride out market downturns. The DCA-based portfolio can maintain a healthy balance while retaining the upside potential to improve portfolio value over time. Number 4. Promotes disciplined saving. The idea of adding money to an investment account on a regular basis highly promotes disciplined saving because the portfolio balance grows even while the portfolio's current assets depreciate. You have to keep in mind, however, that prolonged market fall can be harmful to the portfolio in the long run. Number 5. It prevents bad timing. Market timing isn't something that many investors, even the most experienced, can master completely. Investing a lump sum at a wrong timing can be dangerous, and it can have a whole lot of negative impact on a portfolio's value because market swings are difficult to anticipate. The dollar cost averaging technique smooths out the cost of purchasing, which might benefit the investor. Number 6. Manageable emotion savings. Emotional investing is a common occurrence in behavioral theory, owing to a variety of circumstances such as but not limited to making a large lump sum investment and loss aversion. Using DCA is a good way to eliminate emotional investing. A disciplined buying technique based on DCA allows investors to focus their efforts on the work at hand while removing news and media hype about the stock market's short-term performance and direction from the sources. Using dollar cost averaging can have a few disadvantages as well, so you want to make sure that you review those too. Number 1. Transaction costs tend to be higher. Since dollar cost averaging encourages buying securities in small increments over time, investors risk having to pay significant transaction fees, which could outweigh the gains made on current assets on the portfolio. But still, this will mostly depend on the sort of investing strategy used, as some mutual funds have high expense ratios that might have a negative impact on portfolio value over the medium to long term. Number 2. Priority of asset allocation. Those who are not in favor of using the DCA method claim that in order to minimize risks, an investment strategy should focus on the intended asset allocation. Pursuing a DCA will exacerbate uncertainty by delaying the achievement of goal asset allocation parameters. Investors should be able to dynamically realign their portfolios to hedge against loss and take advantage of new possibilities as the economic and physical environments change. However, for a DCA investor, the offer may be unsustainable. Investors should put money in a money market investment account, where it will collect interest while waiting to be deployed to other strategic assets under the new asset allocation. Number 3. Expected returns are low. The risk and return dynamics theory are pretty straightforward. High risk equals high rewards, and low risk equals low returns. With that in mind, you can say that using a DCA strategy to decrease the risk will most likely always result in lower returns. Bond markets with rising prices often last longer than bear markets with falling prices. As a result, a DCA investor will more likely to miss out on asset appreciation and larger gains than a lump sum investor. The chances of not being able to achieve higher returns are higher than the chances of preventing portfolio value loss. According to a 2012 analysis by Vanguard, a US-based investment firm, a lump sum investment would have produced substantially higher returns than DCA 66% of the time in the past. Number 4. It's a complicated process. The work of DCA in monitoring each scheduled investment over a specific time horizon can be a complex process, especially when the cost difference between a lump sum investment and a scheduled investment isn't that significant. It would take more time and effort to manage and track each contribution, making it more complicated than a lump sum investment. We hope you enjoyed this video. Again, don't forget to subscribe, like, click the notification bell, and leave us a comment below. We love to hear from you, and we'll be doing a random name drawing of the first unique 100 commenters who also like the video and subscribe to the channel. The lucky winner will get a $20 Amazon gift card. So get involved and don't be shy.